Okay, so let's get started. Our first company for today is Prime Financial Group. Prime's ASX code is PFG, and it has a market cap of approximately 50 million. Prime is an advisory, capital and asset management group operating across 4 key areas in accounting and business advisory, wealth management, SMSF and capital markets in its 3 core locations of Melbourne, Sydney and Brisbane. Presenting today is Simon Matter, the company's Managing Director and CEO. Simon, it's great to have you back on the Hidden Gems webinar series. Please take it away.
Great, thanks, Manny, and thank you everyone for attending. Look forward to updating on our half-year results. So if we jump to the first slide, please. So I think Manny sort of framed it up well. We are an advice, capital and asset management group. We currently have around about $1.2 billion of funds under management, including a recent acquisition undertaken in the alternative asset funds management space. We've got 170 magnificent team members that work across not just Australia, but New Zealand and globally as well. We do deliver 4 key services, which Manny highlighted, which is accounting, wealth, capital and SMSF. But there are 2 key segments that we operate in, which is really for emerging businesses that are anything between sort of pre-revenue through to 100 million turnover, and also within the wealth space and wealth management, and more typically for wholesale and more sophisticated investors. This is our 25th year of business, and we're probably in one of the highest growth stages of development of the business that we've had really over that journey. So very exciting times for Prime, our shareholders and our team. Next slide, please. So in terms of our growth and our focus, really over the last 4 to 5 years, we're very comfortable to state that trajectory will continue. We turned over $26 million in FY22, and we see that increasing to $50 million by FY25. We then want to double that revenue to $100 million by between FY28 and FY30. We're doing that through organic growth, and that is across all 4 of our service lines, being wealth, capital, accounting and SMSF, but also through a consistent program of rolling out new service offerings for those 2 key segments I spoke about. So we've rolled out debt capital advisory, sports, entertainment, media and capital advisory, consulting, property, and we've also expanded what we're doing in the wholesale investor space as well. In fact, this has been, over the course of the last 6 to 12 months, the most active we've been in rolling out new services for probably 5 to 6 years. That has been complemented by increased acquisition activity. And over the last 16 months, we've acquired 2 businesses. Intello, which is an SMSF B2B business that we acquired in October of 2022, has the benefit of delivering services for accountants and financial advisors, a white label SMSF service, but it's also acting now as a distribution base for the products that we are developing in-house as well. Altor, which was a transaction we completed just over a week ago, which again is going to fit within our wealth segment, alternative assets within wealth. That has just been recently acquired. It has 2 key funds that we're focused on, one in the private credit space, which has very strong tailwinds at the moment, and also in private equity. We continue to be on the lookout for EPS accretive transactions, and our activity is significantly increasing in that space. So our growth will be both organic and inorganic through acquisitions, and we are also focused on making sure we increase the size of the audience we can deliver group services to. Next slide, please. So just a bit of an overview of our highlights for the half year. Revenue continued to grow, up 14% to $18.2 million. EBITDA was up a reasonably modest 2%. EBITDA margin was 21%. We have reported earnings of negative 0.02 cents per share because we had quite a few to the tune of $2 million one-off non-recurring items in the first half. Our dividend was up 7% to 0.75 cents per share. And our debt's around about 1.4 times underlying EBITDA, but that will come down to being around about 1 times over the course of the second half. Next slide, please. So really, these are the key things that we've been focused on for this half just gone. We've had strong top-line growth, and that's also been in an environment where it's been more challenging from a capital markets point of view. The real standout in our business has been the wealth management performance. That has been up 38% on the previous corresponding period. But that's not to diminish what's occurred across accounting and business advisory, SMSF and capital. which are all up between 1 to 12% versus their previous corresponding periods. As I said, it's been the most material investment that we've made in new services in really the last 5 to 6 years, and we did complete that acquisition post-balance date in that alternative asset management space. So although equity capital markets have been more challenging within the capital division still grew by 12% because of the debt capital advisory and consulting growth that we have within there. What's really encouraging is the number of new client engagements we've got, not just in Prime's capital division, but in fact across the whole business. We're growing our client numbers, we're cross-delivering more services, and the business as a whole is getting stronger each year. I've mentioned our EBITDA performance. On the non-recurring items for the first half, it's worthwhile noting that about $1 million was spent on acquisition-related costs and repositioning, and about $1 million was spent on new service offerings. I've talked about the interim dividend being up 7% for the first half, but we've also put in place a dividend reinvestment plan for those shareholders that want to continue to invest in the growth through new shares and the DRP. We are maintaining our guidance for the year, which is to have revenue grow 15 to 20%, underlying EBITDA to be up between 10 to 15%, and dividends up 5 to 10%. It's worthwhile noting that Prime's business is split broadly 30% of our EBITDA is in the first half and 70% in the second half. So we continue to grow the business, the revenue growth trajectory is strong, and we very much want to move out of micro cap land into a larger market capitalisation. Next slide, please. I've touched on a lot of what we've got here, but really I just probably reinforce the strength of the wealth management business. That was really a difficult area to be involved post Royal Commission, but that's now really found its stride as actually growing in quite a compelling way, really driven by our property origination. Our clients very much want to invest in that housing theme, and we're finding plenty of opportunities in both equity and debt within that property space. Next slide, please. This gives you a bit of a feel in terms of the revenue for the firm. 70% of our revenue is recurring in nature, and we've been growing over the previous corresponding period by about 14%, 31% prior to that, and 14% before that. So a good consistency towards our trajectory of 50 million turnover by FY25. Next slide, please. This gives you an idea as to how each of these areas have grown over the last 4 years. So you're seeing a real consistency to the shape of that revenue. What I would have just highlight there is that 38% is very strong from a wealth point of view, 12% for capital again is strong. The accounting business, I think, will have a stronger second half than the first half, and SMSF was focused on integrating the acquisition that took place around about 12 to 14 months ago. So we'll continue to focus on growing these service lines, cross-delivering more services to those key client segments we've got, being business and wealth investors, and drive the business forward. Next slide, please. I've touched on the underlying EBITDA and the reported EBITDA, so I probably won't spend a huge amount of time here other than simply say our EBITDA margins are driven substantially by the labour costs that we employ to grow the revenue. And if at any point in time we feel like we wanted to get straight back to 30%, we would just cease those initiatives that might be taking longer to grow. So really what you're seeing here is us investing for future growth in revenue and totality of our EBITDA, which allows us to drive market value and dividends. Next slide, please. I've touched on our net debt position at 1.4 times. As I said, that'll moderate down with better operating cash flow in the second half. We've got more tied up in working capital as we've rolled these new service lines out, and typically it takes about 12 months for a new service to start to make a positive contribution to the business. We've currently got facilities available to us of around about $10 to $12 million, so we can continue to be proactive in the marketplace. Next slide, please. This gives you an idea of the shape of our dividends. We've typically paid out 50 to 70% of our earnings. We have increased the dividend by 7% for this first half. That is within that range of 5 to 10% growth. The DRP is in place for this interim dividend, and we encourage shareholders to have a think about that. Next slide, please. So in terms of the strategy for doubling our growth, it really sits in these two segments which I've highlighted, and how we surround these ideal clients with a group of services they can't typically get from one connected organisation. So you've got those emerging businesses on the left, whether they want accounting services, consulting, business advisory, they want to get access to an R&D tax incentive. That all fits within that emerging business segment. So we're there to help empower the founders, the owners of that business to achieve their aspirations. And on the wholesale client investor front, we look after the client's total asset allocation, but we have specialty around alternative assets and property. Capital is a piece that sits between these two areas and connects them together. Next slide, please. So in terms of the strategy for growth, we'll keep growing the top line, organic growth through the existing services, new services, cross-delivering to the existing client base, building that client base, and then making sure that we add the most amount of value for them. Diversifying revenue through new and emerging strategies like what we've done with Altor Capital, the alternative asset manager. We've built the plumbing for the business to expand our margins in the future. We put on new people to grow the revenue, and the vast majority of that drops to the bottom line. Our target margin is a 30% EBITDA margin. We do have the balance sheet to grow the business. It's great being a listed company, which means that you can access capital, but we want to be a business that can pay an income stream to our shareholders and grow significantly in what is an exciting space where we don't believe that anyone has really put this together as well as we can for the future. Next slide, please. So the outlook, just to confirm, we'll continue to grow the business strong. From a strong point of view, from an organic perspective, we will undertake accretive acquisitions. We do have the scale in the business to drop that to the bottom line and a strong EBITDA margin, and we are confirming our guidance for the year. Revenue up 15 to 20%, EBITDA up 10 to 15%, and dividends up 5 to 10%. That's the end of my presentation. Manny, back to you.
Thank you, Simon. That was great. Yeah, a few questions for you. So why don't we start with, you've got some pretty aggressive revenue targets, heading to 2025, such as doubling your numbers between then and now. You did say it's you have got a combination of organic and some M&A in there. How is that? I mean, how do you expect to split that growth between M&A and organic? Is it very much skewed to the organic side?
Look, for the last 5 to 6 years, Manny, we have focused on making sure that we had the team that we needed to drive the business from an organic growth point of view. That team owns 45% of the business, and we've got 170 staff. So an ownership mentality internally is important so that everyone can think about everything we can do for the client. So it's been very much organic growth focused. So we've now got this suite of services we can offer to those segments, and we just want to grow the audience we can deliver it to. So we don't need a huge number of services to roll out beyond what we've got for the next 12 to 18 months. And so that's why we've stepped up the acquisition activity, because that will help us to deliver more value to those customers and enhance audience size, drive EPS as well, and become a more relevant scale-based business. So if you were to look to the future, you've always got to have the organic growth being driven. I think that an acquisition-only model is quite dangerous. So acquisitions for us are complementary to the organic offering that we've got with our customers, but we'll be more active than we have in the past. Done 2 transactions in 16 months. That pace will build, but we'll not take silly risks with the business that we've built over 25 years. We'll work within the constraints of our balance sheet.
Okay, great. And in terms of M&A targets, you've spoken about that, but are there obvious M&A targets for you guys on the radar that you're looking at? And if you were to pursue those, how would you be funding them? Would they be funded through debt?
Yeah, so we are very specific. The segments that we operate are in that emerging business segment, and also in that wealth management space. So you'll typically find that everything that we're looking at will fit into one of those 2 buckets. We're very specific about how we structure transactions. We will typically acquire a business with half cash, half shares, and we'll also make sure that that's done over time, and that's typically 2 to 3 years. We want to acquire businesses where the principals want to be part of the collective group and offer more services to their clients and operate under the Prime brand as we build that out even further. So some of the funding occurs by virtue of the fact that when you acquire these businesses, they have sufficient working capital to operate in isolation. But then, obviously you've got the share issuances that you undertake, and you might use a little bit of debt. But we want to keep that debt at that modest level of about 1 times underlying EBITDA, and we don't want to stretch the balance sheet. So between those mechanisms, we're able to do a reasonable amount of acquisition without sort of biting off more than we can chew.
Okay. And you've also talked about the dividend during the presentation.
Yep.
Can I just to be clear for investors, what is the dividend policy going forward? Do you have a set policy on payout, or how does that work?
Yeah, so we've had the same policy for really probably 3 or 4 years. We're paying out 50 to 70% of our maintainable earnings. That's why it has managed to continue to increase over that period of time, because our earnings have increased quite substantially. What we're suggesting going forward is that dividends will continue to rise by 5 to 10% each year. We'll probably retain a little bit more than what we have in the past to fund the future growth that we've spoken about already. But we think it's essential that clients receive, not clients, but shareholders receive not just an income stream, along with the ownership that hopefully comes with capital growth as well. So we're steadfast in that policy.
I think you're right about that. I'm pretty sure shareholders do appreciate that view. And just sort of with regards to the market as a whole, it's no secret it's been a tough couple of years out in markets, certainly in capital markets. What's your outlook? Well, what's your view or your feel for what the financial and capital markets might look like over the next 12 months? Do you see a recovery?
Yeah, look, I think that things are improving. I think that there's, it could take 6 to 12 months for the pace of recovery to pick up. But what we're seeing with clients, and even at the start of this year, there's more engagement than what there was in the past. And I think everyone was very sort of conservative in the last 12 months, and naturally so. And that's why you've seen equity capital markets off that 35 to 40%. But I think things are moderating, and we're more optimistic about the future, and we're seeing people increasingly looking to do things. So I think we're sort of out of that trough and heading back in the right direction. And we're starting to see the pace of things start to pick up a little bit, which I think we've sort of bottomed out on that cyclical nature of that part of our business, which is really only a small part, given we've got 70% of our revenue is recurring in nature. But it's an important part of what we do, because we originate interesting transactions for wholesale clients that want to see something different than what they actually just might get elsewhere. So I think we're on the up, but it'll be sort of a slower rise, I think.
Okay, Simon. Well, thank you for your time today. That was great, and have a fabulous weekend.
Appreciate the time. Thank you, Manny.